Medical Properties Trust stock has been hammered in the last year and is down 45% at the time of recording. This makes its dividend yield a lucrative 9.8%, which definitely drives interest from dividend-looking investors and makes the stock seem undervalued right now. But before deciding whether to buy the stock or not, one must understand the reasons for the huge drop last year. In this video, I will share my comprehensive analysis of the MPV stock so that we can figure out why this stock has been getting crushed. Medical Properties Trust is a self-advised real estate investment trust formed in 2003 to acquire and develop net-leased hospital facilities. It's one of the world's largest owners of hospital real estate with roughly 430 facilities and 44,000 beds in 10 countries and across 4 continents. First, let's have a look at a few other REIT stocks' performance for the last year. Sabra Healthcare REIT is almost flat for the past 12 months. Realty Income had some huge losses but recovered and is currently only 1.5% down. WPC was even up 9% for the past 12 months. One of the biggest headwinds for all REITs are the rising interest rates, of course. As the Fed seems to go on with rate hikes, investors are worried that higher debt payments mean lower profits and prudent REITs will cut payouts and reduce debt instead. The first point for MPV stock to be down is the company needs to reduce payouts significantly and pay off debt in order to avoid issuing new debt at much higher rates. Second reason for the MPV stock to be down. In October 2022, the company was sued by Block and Leviathan for potential securities law violations. This came after the Bear Cave newsletter issued an updated report on MPV stating a haphazard assortment of issues including distressed tenants, dubious representations, excessive spending, potential auditor independence issues, and a perplexing undisclosed entity for property management. The stock was down 6% on this single day alone. The biggest headwind for MPV stock, however, was the case with Stewart. Medical Properties Trust has come under bear attack by short sellers last year, with allegations of a circular financial relationship with the operations of the hospitals whose real estate Medical Properties Trust owns. In other words, Medical Properties Trust is lending money to its biggest tenant. The bears allege that Medical Properties Trust is popping up some of these hospital operations, particularly Stewart Health, who are basically insolvent by lending them money so they can keep up with the rent payments to Medical Properties Trust. According to the bears, this is a house of cards which will come crashing down. The good news is, in January it was announced that Stewart had the bank line extended and it didn't bankrupt so far. The MPV stock analysis wouldn't be complete if we don't mention the positive points too. After diluting the stock in early 2021 with 32 million new shares, at the end of last year the board of directors authorized the repurchase of up to 500 million worth of US dollars of MPV's outstanding common stock before October 2023. The 3-year share buyback ratio is minus 17.2%, which means the REIT has been raising money via sales of new shares. The reverse of MPV's dilution policy from the last few years is definitely good news for us investors. It remains to be checked if the company will follow through with the buybacks planned. Next thing I like on MPV is its strong financials. I won't go into all details as I think this video should be just a starting point in your research, but I will mention the AFFO or adjusted funds from operations, which seems impressive. The dividend payout ratio is 0.55, indicating a strong ability to pay dividends. The growth rate for the past 5 years was 4.1% and the yield on cost for the past 5 years was 11.48%. The company's balance sheet appears to be healthy with an equity to asset ratio of 46%, a debt to equity ratio of 1.09 and a comfortable interest coverage ratio of 2.68. Medical Properties Trust's position is that dividends are well covered and come from inflation-protected cash flows. The company has a track record of raising its quarterly dividends for 8 consecutive years. In conclusion, I can say, while the bears have a point that concurrent equity and debt investment in tenant operation can amplify risk on the company, I think the market has overreacted to the downside. At a 10% yield, it makes sense to nibble into a small position simply because they are in the hospital business, a somewhat guaranteed industry. In my opinion, the stock price is seriously undervalued, even factoring in a worst-case scenario with Stewart. Even if they default on the debt and declare bankruptcy, MPW will take over as the equity owner and then work on selling the equity position. In that scenario, they would still recover most of their investment. It really comes down to timing and having enough wiggle room to lose cash flow from their troubled tenants and still be cash flow positive. I think they have that wiggle room. I see a good opportunity to buy more MPW stocks in case they do some dividend cuts, and this drives the price even further down. If you like my analysis, support my channel by subscribing and don't forget to like the video. Let me know what you think about this stock in the comment section below.